Right now, the world is absolutely buzzing with the promise of artificial intelligence. I mean, stocks are just soaring to unbelievable heights. But is this incredible boom the start of a whole new era of innovation, or are we just watching history repeat itself? So that's what we're digging into today. Is this AI gold rush actually the next great financial bubble?
Okay, let's just dive right in with a pretty stark warning. Torsten Schlock over at Apollo Global Management sees this direct parallel to the dot-com era. And get this, he's suggesting today's market might be even more inflated. That's a serious claim, and it really sets the stage for everything we're about to explore.
But before we even look forward, we have to look back. This number right here, 8.7 million, that's how many American jobs were lost during the Great Recession that followed the 2008 financial crisis. It's a really sobering reminder of the very real human cost when a bubble bursts. And it's exactly why understanding the warning signs is so critical.
Okay, so here's how we're going to break this all down. First, we'll define what a financial bubble actually is. Then we'll take a close look at the 2008 housing crisis, shift to the current AI boom, and then, this is the fun part, we'll compare the warning signs side by side, and finally, we'll explore what could happen next.
First things first, before we can even start to diagnose a bubble, we need to understand its DNA. What are the key components that turn regular market enthusiasm into a full-blown speculative frenzy? What's the recipe here?
Okay, so this is super interesting. It really boils down to 4 key ingredients. First, you need cheap money, easy credit and low interest rates that encourage everyone to borrow and invest. Second, you need a story, a narrative about some revolutionary new paradigm, like a new technology that's going to change the world. Third, you get that herd mentality, that fear of missing out, that makes investors just follow the crowd. And finally, you get these complex new financial products that kind of hide how much risk is really involved.
All right, let's put that theory to the test with our first case study. Let's see how those ingredients cooked up the 2008 global financial crisis, a meltdown that all started with the American housing market.
This timeline is just wild. It shows how unbelievably fast everything came crashing down. It started with these little tremors in the credit markets in 2007, but it escalated so quickly. By September 2008, the collapse of Lehman Brothers sent the entire global financial system into a total freefall, with unemployment peaking a year later.
And this slide really shows you that toxic mix. The main fuel was subprime lending, basically giving risky mortgages to people who probably couldn't pay them back. This whole thing was supercharged by deregulation and these incredibly complex products called CDOs. And here's the crazy part. They took thousands of these risky mortgages, bundled them together, and then sold them to investors, pretending they were super safe investments. It was a ticking time bomb.
So, what was the final word on all this? Well, the U.S. government's official inquiry concluded that the crisis was completely avoidable. This wasn't some act of God, right? It was a cascade of failures. Regulators weren't paying attention. Banks were taking on insane amounts of risk, and there was a total breakdown in accountability from top to bottom.
Okay, so let's jump back to today and apply that same critical lens to the AI boom. Is all the excitement around this genuinely game-changing technology creating the same kinds of blind spots?
Look at this number, $5 trillion. That's the almost unbelievable market valuation that AI chipmaker NVIDIA was approaching. This one company has become the symbol of this absolute tidal wave of money flooding into anything and everything related to AI. Now, to put that into perspective, let's look at a key metric, the price-to-earnings ratio. A normal, mature company might trade at, say, 20 times its annual earnings. But some of these AI-related companies like Palantir have traded at over 700 times their earnings. Think about that for a second. That means it would take 700 years of their current profits just to earn back your initial investment. It's just staggering.
And this boom isn't really widespread, it's incredibly concentrated. Most of the market's gains are packed into just a handful of tech giants, what people are calling the Magnificent Seven. NVIDIA, Microsoft, Alphabet. Now, part of this is because building real AI costs a fortune in chips and data centers, so it's kind of a winner-take-all game. But that also creates this massive risk, right? Because if just one or two of these titans stumble, they could drag the whole market down with them.
Okay, now for the big one, the direct comparison. 2008 versus today. Let's stack them up side by side and see where the echoes of history are, and just as importantly, where they're not. Is this time really different?
The first, and maybe the most important difference, is the asset itself. In 2008, the bubble was built on toxic assets. Just bad loans that were destined to fail.
Today, the boom is built on real revolutionary technology. Companies are selling GPUs and cloud services that are generating massive, tangible profits. The value is real. It's not imaginary.
The health of the companies at the center of it all is also completely different. Back in 2008, the banks were basically drowning in debt with no cushion to fall back on. Today's tech giants, they are sitting on mountains of cash. They're way more resilient and much better equipped to handle a downturn. So you can see the foundation here looks a lot stronger.
But, hold on. Despite those really key differences, experts like Brent Goldfarb argued that the human element is identical. The story-driven investing, the fear of missing out, the rush of everyday people into the market, all the classic behavioral signs, the human psychology, it's exactly the same. It's like bubble behavior 101.
Which brings us to the trillion-dollar question. So where does that leave us? What happens now? Does the air just gently hiss out of this market, or are we headed for a really loud, painful pop?
Well, analysts generally see three possible paths forward. There's the soft landing, where growth just kind of slows down and valuations gently come back to earth. Then there's the healthy correction, which is a more noticeable drop, say 10 to 20%, that shakes out the speculators. Or there's the one everyone fears, the bubble burst, a rapid, severe crash if investor confidence just suddenly evaporates.
So, why should you care about any of this? Well, because knowing the signs of a bubble isn't just some academic exercise. It helps you separate real game-changing innovation from pure, unadulterated hype. It's about knowing what to look for so you can make smarter decisions when markets get this wild. And let's not forget, we have absolutely been here before. The dot-com bubble in the late 90s is the classic example. The internet was truly revolutionary, just like AI is today. But that didn't stop a speculative mania that ended with the NASDAQ losing almost 80% of its value and wiping out countless companies and investors.
And we'll leave you with this final thought to chew on. Big leaps in technology, they almost always require big, risky bets on the future. That speculation is actually what fuels innovation. But when those bets go bad, it raises a critical question. Who's left holding the bag when the music stops?